This is the Rocket City Retirement Show with Chris Wallace. Chris loves educating people in person and over the airwaves. Whether it's retirement planning, investing, tax, or legacy, Chris prides himself in helping protect what matters to you. This is the Rocket City Retirement Show.
Hi, I'm Lou Ann Fulmer. We welcome you to the Rocket City Retirement Show with my friend, certified financial planner and financial advisor, Chris Wallace. He is president of WG Financial Group, here today to give you some very helpful advice about retirement planning. If you have questions, let's start off by giving you this phone number. This is the way you can reach out to Chris for a complimentary discovery session, 256-937-2010. Okay, 256-937-2010. Call or text the word visit if you prefer to text. We have that available for you. Remember, you can always check us out on Facebook throughout the week. If anything happens in the news, Chris will be sure to post something there. Just look for WG Financial Group 256. And then remember our motto, plan, retire, play. Find us online anytime at WGFinancialGroup.com. And Chris, hello to you.
Hello, Lou Ann.
And then I get to welcome to our show a very special guest today. Joining us is Alexandria Anderson. She is a mortgage loan officer with the Modern Lending Team out of the Nashville, Tennessee area. And we're going to be talking about mortgages today. And Alex has been in the mortgage industry now for 10 years. She is from Lexington, Kentucky, graduated from the University of Kentucky. She's the mother of a wonderful 15-year-old daughter, and she prioritizes education, communication, and customer service to helping people build strong, lasting relationships. So, Alexandria, I want to say welcome to our show.
Hello.
Good to have you here. And we're going to be talking about interest rates, okay? Right now, I should say the mortgage industry. And my first question is, about interest rates, wondering whether or not they're going to go up and how that's going to impact. So in your view, Alex, what do you think the outlook is on the interest rate market that you guys have been hearing on the mortgage banking side?
Sure. Well, if I had an exact answer to that question, we wouldn't be sitting here talking right now. I'd probably be counting my millions. But the temperature of the market, it's been for some time, we've suspected rates to go down. Initially, we were thinking probably Q2 of this year, and now it's looking like it's probably going to be closer to Q4 towards the end of this year. We hope it's sooner than that, but we'll see.
Yeah, I kind of, just to kind of chime in a little bit here too. I think, on the advisory side, we're kind of in the same boat as well. We saw the rates drop in third-ish quarter of last year, and then they started going back up. And a lot of that had to do with inflation just being real sticky. And then if you do look out, I've actually got the Fed Fund futures pulled up here. And if we're looking at the March 19th meeting, the Feds really aren't expected to lower rates in March. Now, I always say when we talk about the Fed Fund futures, we're pretty good ways out. So it's a little bit less accurate, but the closer we get to March, the more accurate that'll become. And like I said, as of right now, it's a 95% chance of no change. If we go all the way into October, which is really far out there, it's all over the map. It's showing rate drops all the way down to 325, but the largest percentage is still sitting at 400 to 425. So it's predicting way out in October there could be, a quarter point drop, but it's so far out it's kind of hard to say. I think a lot of it is going to have to do with how inflation behaves between now and then. And then we know that DOGE is digging around in the government spending and stuff like that. So yeah, well, we're kind of in the same view. Slower drop is what your people are. Sounds like what your people are kind of saying as well. And by the way, I do want to say this. Alex is on the show because I felt like it was good to bring a guest on. I'm going to have another guest next week. Surprise! So you have to tune in again, just to break up the monotony of Chris and Graham talking about Social Security, Medicare, taxation, investing, and all that. I just thought maybe, what I know Alex. She's from the town where I live, and she does great with her clients. And I say, it'd be a good thing to have you on the show and just kind of talk about mortgage stuff that people may not know. So I think the show today is going to be pretty interesting overall.
I'm excited that we're going to do this. A question I have for you, Alex, is, how does a consumer determine which type of mortgage they need? Because there's several different kinds.
Well, the easy answer is call me, right? Call me. I can help you. There's several different mortgage types. The main ones that everyone's heard of is, FHA and conventional. In addition to that there's VA, veterans, USDA, and there's others beyond that. But typically what I do is, my job as an advisor is to ask you a series of questions that will kind of help guide me. It's a deduction to get you into the program that's going to best suit the needs of you and your family. And biggest things I ask are, how much, if any, do you have saved up to put towards your down payment and closing costs? What purchase price do you have in mind? What's your credit score, right? And if you don't have a purchase price in mind, what's a monthly budget? I think that's more of an important question, because someone could want, $1 million house, but they only want to spend $2,000 a month, and they have, $5,000 to put down. I'm like, well, you're going to have to pick one. Yeah. I can make you happy on one or two of those things.
The math doesn't work.
Right. Right. So those factors kind of play in and help guide me to the program that's going to work best for you.
So let me ask you a couple of questions here. This is great because there's a lot, believe it or not, that the all-knowing retirement planner, Chris Wallace, doesn't know about mortgages. When we talk about FHAs versus conventional, what are the main differences there? Is that more of a down payment thing, or is that more of a credit score? I'm going to try to make some questions up here because I don't know. So FHA, can you have less of a credit score with FHA?
Yes.
Okay.
FHA's more lenient on their guidelines, more lenient on debt to income. Minimum down payment is 3.5%. Minimum credit, 580 for most investors.
Okay.
So the investors are going to be buying the mortgages. 580 is about the minimum there. Mm-hmm. Whereas conventional, 3 to 5%, depending on your income bracket, and you want to have better credit. And the reason for that is, so many people think on a conventional mortgage, you have to put your standard 20% down, which is false.
Right. That's what I'm sitting here thinking. You're saying 3 to 5, and I'm going, wait a minute. I'm like making notes over here as we're talking, and I'm thinking, I didn't hear 3 to 5. I heard 15 to 20.
Yeah. 3 to 5%. And so anytime you put down less than 20% on a conventional mortgage, you're going to have PMI, private mortgage insurance. Mm-hmm. And that basically just ensures the loan for the investor. This is something happened, back in 2006 through 2009 when the market kind of crashed, but this protects the investor's investment. So PMI is based off of two things: your percentage of down payment and your credit score. So if you have great credit and a halfway decent down payment, I'm probably going to steer you towards conventional, but conventional loans have higher interest rates.
Really?
Uh-huh.
So I would have thought it would be the other way around.
No, your FHA and VA are going to have lower interest rates. Okay. And lower down payment requirements. They're not as strict on the rate as far as credit is concerned either. Mm-hmm. And I would say it was 2 years ago, FHA had too much overflow and reduced the PMI percentage. It used to be 0.75%. Now it's 0.55%. Okay. But the thing with FHA, you have PMI for the life of the loan, whereas on a conventional loan, as soon as your loan to value drops below 80%, you can drop that PMI.
Yeah. That was something that happened a while back, actually. And if you're listening to the show and you haven't done this, because home prices have shot up so much just because of the market, I was able to several years ago get rid of the PMI just by having my house reappraised. I think I paid, I don't remember, like $500 or something like that to have it reappraised, and then there goes my PMI.
Just a phone call.
That's good. So that's a great. Actually, I'm glad you talked about that. But we didn't have that on our little note sheet here. But if you're listening to the show and you're still paying PMI, there's a good possibility if you've had your house for several years, you might be able to get out of it just by a simple appraisal. Yes. I almost said reevaluation or refinance, and I was trying to say the word appraisal. So yeah, awesome. Yeah, good stuff.
All right. Anything else on that a consumer needs to know, or
I do have a question about, do you guys do a lot of like ARM loans? Is that something you guys do a lot of?
I used to.
Okay. I'm not as familiar with those. I think they have a period of time where your rate is set, and at the end of that term, it can adjust based upon prime or something like that.
So no. So with an ARM, ARM stands for adjustable rate mortgage, right? So there's several different kinds. There's a 5.1, a 7.1, a 5.2. So how that works is, let's say, for example, you have a 5-1 ARM. Your interest rate is going to be fixed for the first 5 years. And then after that, if it's a 5-1, it can adjust based on, like you said, prime each year after that.
Okay.
And then there are caps. Usually it's like a what they call a 5-2-5. So it can adjust 2 points either way in the first year and going forward, but never more up or down 5 total points over the life of the loan.
When would be a good time to get an ARM loan?
When it's better than a fixed rate mortgage.
Yeah. So what about now? Like if we, just guessing here, let's say that rates are projected to drop.
Sure.
Would now be, and obviously we're not giving mortgage advice here. I want to make that super clear, but I'm just trying to think of ways, okay, when would an ARM make sense? Because it's kind of risky.
Very.
So at the end of that 5 years, you're like at the mercy of interest rates.
Sure.
But if interest rates are going to drop, then would an ARM sometimes make more sense in some cases?
Typically, I would only recommend an ARM to somebody who's going to do a short-term investment.
Okay.
And actually here in the greater Nashville metro area, 4.5 years is the average that someone stays in their home or in their current loan.
Oh, wow. I didn't know that.
Yes. So, every 4.5 years or so, people are turning. It might make sense for you if it's going to be short-term investment or, you're not going to be in that home or in that property for that long.
Yeah.
Or like you said, Chris, if you think rates are going to continue to go down, great. If they don't go down enough at the end of that ARM term, then you can always do a refinance and go into a fixed rate mortgage.
Okay. That makes sense.
That kind of brings me to this next question. When is a good time to refinance? Like when you can save 1% or 1.5%, 2%, or should it be more?
Well, that depends. And Chris, you and I were talking about this the other day. If I'm going to save 1% on my mortgage by refinancing and I have a $700,000 loan, absolutely. That's going to save me, probably close to $500 a month.
Wow.
But if I have a $200,000 mortgage, well, that might save me $50 a month. And by the time you add in closing costs on top of that, you're break even. I might not be in the house long enough for that to make sense. So it is going to be a case by case scenario. But another good time you may want to refinance is, there, in addition to a rate and term refinance, is a cash out refinance. If you need that cash and it makes sense and it reduces your overall monthly expenses, absolutely.
Yeah. So like if I have, sorry, Luann, I just want to ask this quick question here. Like a cash out refi would be possibly advantageous for somebody that maybe they have a bunch of runaway credit card debt and they just can't seem to get it paid down because they can't, make the extra payment or whatever. The cash out refi, you could take the cash out of the value of your house essentially, and then it's amortized in over that loan period, and they take the cash and pay off the credit cards.
Yep.
Right. Okay. But then you want to cut the cards up, cut your hands off, so you don't log online and apply for another credit card. So, all right. So a cash out refi is sometimes okay for that. Any other reasons? Maybe home remodels for the cash out refi.
Home remodeling. I've and lots of times seen people that'll come through and they'll fill out an application. They've got a $1,200 to $1,600 car payment, or they're paying 29% interest, like you said, on credit cards and things like that. If I take that same car payment and I amortize it over 30 years at 7%, well, it's going to cut your overall monthly expenses down pretty drastically. But also it depends on the rate that you currently have on your home. Yeah. If you're sitting at 2.75% and you bought your house, back in 2020 or 2021, I'm going to tell you, don't lose that rate, right? That might be a time to go take out a home equity line of credit and pay towards that. See, Luann's agreeing with me there.
We've done that before.
Right?
Yeah.
And a home equity line of credit, the interest rates are based on prime. It's going to be lower than if you went and financed it or put it on credit cards. And as long as you're diligent about making those payments, that's absolutely the way to go. You can borrow against it anytime you need it. I
mean, your house is an asset. The HELOCs, home equity line of credit, they're generally 10 years?
Yes.
Okay. Yeah. So you want to be diligent.
Yes.
Because at the end of 10 years, that's going to that's going to come due.
It is an interest-only payment, so a lot of people don't understand that. They're like, "Oh, this payment's so much cheaper."
Yeah,
You're not paying anything towards it unless you pay extra.
Right.
But the good news about that is, and some people don't know this either, is even your fixed conventional or FHA mortgages, they're amortized interest heavy up front, and then it's a tipping scale over the course of the life of the loan.
Mm-hmm.
Well, whereas a HELOC, I can decide how much of that payment goes towards principal and how much goes towards interest.
Mm-hmm.
And then it's less interest that I'm paying each payment, the more that I pay that down. So you can set your own amortization schedule, essentially.
Oh, really? I didn't know that. I don't have I have a HELOC, but it's zero balanced. I just kind of have it sitting there for kind of like a secondary emergency fund, if you will.
Yeah.
But I didn't know that about the setting kind of your own schedule there. I actually didn't know that. So good information. Yeah. Awesome.
And at this point, I just want to say you're listening to the Rocket City Retirement Show. We thank you so much for joining us. I'm Lou Ann Fulmer here with certified financial planner and financial advisor Chris Wallace of WG Financial Group. And also joining us today is Alexandria Anderson, and she is a mortgage loan officer with the Modern Lending team out of the Nashville area. So if you have questions, you can certainly call her. We want to make sure that you understand that. But I wanted to mention that's who we have on our show. And that's why we happen to be talking about mortgages today. Very interesting, I think, with just the way housing is right now. It's been really kind of disappointing, Alex. You know, I used to like to look at houses just for fun, you know, and now, man, they are just out of my range, you know, so certainly gone back up again. But I want to get back to that cash out that you guys were talking about, because I don't quite understand it all. Explain what happens in a cash out refinance. And again, when is it useful?
Sure. So in a cash out refinance, there's two types of refinances: your rate and term, where you're either reducing your rate or your term, or a cash out where you are taking equity out of your home, putting cash in your pocket. Okay. Oh. And that gets rolled into your current mortgage, or it starts a new mortgage as well. And that, like I said, would make sense when it helps reduce your overall monthly expenses, you know, a home remodel. I definitely don't advise my clients to, you know, get rid of those 2% and 3% interest rates. If you can do a home equity line of credit and be diligent with that, I can, you know, have those products available as well. But it's, you know, it's up to the individual. But cash out refinance is a great way to take care of some of those things. But you can only borrow so much as well. Max loan to value on a cash out refinance is going to be 75% on a investment property, 80% on your primary residence. So you can't borrow too much. The bank still has to have their skin in the game as well. Mm-hmm. So based on how much you need, that might be a difference in what type of product or what type of loan you go with as well.
Okay. And then we were talking about refinancing. Tell us about some of the fees involved with that.
Well, refinance is going to be a lot less expensive than on a purchase. You're not going to have your state tax stamps, but your typical lender fees, most of the time you're going to need an appraisal, credit report, you know, employment verification, things like that, and title fees, which you can have a little bit of control in that. You get to pick your own title company. Your lender can pick it for you. And then what I call your anyway money, your taxes and insurance for your new escrow account. You're going to have to pay those anyway, but you will get a refund back from the current balance. If you escrow property taxes and homeowners insurance, you're going to get that money back out of your current escrow account. And you can also skip a couple of payments when you do that refinance as well.
So, Alex, let me ask you about this. What about recasting your mortgage? Is this something that needs to be considered at times?
Absolutely.
Okay.
I love a good old recast.
Oh.
So what a recast is, for those who don't know, is when you apply a large lump sum payment towards your existing principal balance, and then the servicer will re-amortize your existing loan based on the new principal balance. So you get to keep your same interest rate. Your term doesn't start over. You just get a new lower monthly payment. It's basically a really cheap refinance.
Wow.
Yeah. And some companies, if I'm not mistaken, don't always allow it.
Oh, they don't?
No. And if it's something that you're interested in, I do this a lot for my customers who would like to purchase a home before selling their existing home.
Yes.
And you know, you may only have 5% to put down at the time, but when you sell your current home, you're going to, put an extra $200,000 or whatever that equity is, right? You're going to put that towards the mortgage. And it's a way to set up your new home, your new loan, as if you had already sold your home once it does sell.
Right. And then I think what I hear you saying is you take the sale proceeds from the current home and apply that lump sum towards the principal of the new finance. And then you do a recast there.
Correct.
And it lowers your payment down.
Interesting.
Yeah, I think this also works too if if you get a large bonus or something. I've thought about this a lot because I actually have talked about recasting on the show before because I felt like it's an excellent way of, again, just mentioning a bonus here. You get a $100,000 bonus and you want to apply it somewhere. First of all, you should pay off all your revolving debt first.
All
and
your
make sure
debt,
you're,
yes.
Yep.
yeah, and maxing out the credit cards and all that before really attacking that principal. And in some cases, it makes sense. So I don't know that I would do it towards a loan that has an interest rate of like 2.75. I feel like you can make better use of the $100,000. But let's say you were like 5% loan rate and you got a $100,000 bonus. Applying the $100,000 towards principal and then doing a recast would lower that payment down. It wouldn't change the interest rate, kind of like you said, but it could lower that payment down a little bit there. So
absolutely,
recasting, I think it's an excellent tool that's not talked about enough by enough people.
Plus,
so
it's going to save you overall interest
For sure.
over the life of that loan as well. Now, keep in mind, you cannot do a recast on all mortgages, just conventional. You cannot do that on government mortgages, no VA, FHA, USDA. So make sure if this is something that you're considering, check with your lender, check with your loan officer that it is going to be an option, that you have the right loan product for that, and that your loan officer puts you with an investor that can allow it.
Gotcha. What are you seeing as far as I don't know, maybe issues today with buyers? I mean, we know rates are through the roof, relatively speaking. Like historically speaking, they're not bad.
Right.
But let's be real, since, for the last 15 years, we've been in, zero interest rates for quite a while.
We're spoiled.
Yeah, exactly. Yeah. And so this is a sticker shock to a lot of people, especially the Gen Z, the millennials who grew up in basically zero rate, policy. So what issues are you seeing today? Are you just seeing people that just can't afford it? I mean, what are some of the issues with trying to buy a house today that really didn't exist, say, 5 years ago?
Right. You hit the nail on the head. It's absolutely an affordability issue, especially, back in, I guess it was January of 22 when rates really started to creep up on us. I'd write a pre-approval letter, one day, and then 2 weeks later, I'm having to redo the pre-approval letter because the rates have gone up so much. Now they're priced out of a certain bracket or out of a certain market. So 100% an affordability issue. People aren't doing the multiple offer and overbidding on a house and things like we saw, 5 years ago either. Also, our first-time home buyers, their purchase price has a lower average than it did 5 years ago for that exact reason.
Yeah. As far as interest rates go, just kind of as a reminder, I know you know this because you're in the industry, but mortgage rates tend to follow the 10-year treasury to some degree. So if the 10-year treasury's up, mortgage rates will be up. If it's down, typically mortgage rates will start to fall. There's a little bit of a lag there as well, but it tends to follow the movement of the 10-year treasury. Now, there's always a what I call like a little spread or a gap between that. And I was actually just going to look today and see what the 10-year treasury is trading at. It's basically 4.53. So the average mortgage rate's probably, you know this better than I do, but probably nationally somewhere around 7%, would you say?
Yeah. And also keep in mind, when you're looking at bank rate or even going on to look at the Fed prime rate, you'll see that rate. Always look for the asterisks. Because it'll give you a list of brokers and their rates, and a lot of times there's going to be points attached to that and fees and so on and so forth. When you say that rate, you're looking at par, right? Nobody's making any money. That's just with the rate. So there's going to be fees and things built into that as well.
So there's typically a 2.5 to 3% spread over and above the 10-year. So 10-year's trading, like I said, at 4.53 ish today. So we're looking at rates somewhere in the low sevens.
Yes.
So, but that's kind of interesting to just for the consumer to watch. So as the 10-year yield starts to drop, you can probably, it's not exact. It's not a one for one thing, but if the 10-year yield is dropping, then you can probably safely assume in the very nearer future, you're going to start to see rates drop as well. And if you just look at like 2020, I want to say it was like August of 2020. I think the 10-year treasury was trading at like 0.5. So that's where these like really low, that's where my rate came from. I'm currently in a 2.75 interest rate. And I jumped on it to refinance at the time. And I've met with people, believe it or not, have come into my office. They have 5% interest rates. And I'm like, wait a minute, why didn't you refinance? And the common response I hear was, well, I didn't think it was going to save a lot of money, and I didn't want to pay the closing costs and the fees associated with the exactly. That's exactly what I say. No. In my head, there's some other things going on there, but it's like, how can you not like refinance off a 4.5 interest rate to get in the high twos?
Yeah, that's free money.
Saving in the long run. Yeah.
Well, yeah, but this is where this is a big hurdle mentally and psychologically for a lot of people is the fees. It's like, okay, I'm going to work with a loan officer or a lender, and they're going to make commission, or there's going to be some closing cost fees there, and I don't really want to pay it. And that's kind of the attitude. That's a psychological thing with a lot of people. But I'm thinking, and I'm specifically thinking of two different families I've met with in the recent history where they were over 4. I want to say they're around 4.5. And they could have refinanced in 2020, but they did not do it because both of the comments to me was, well, we just didn't want to pay the fees.
Oh my
gosh. And I'm thinking, why would you
It breaks my heart.
Yeah, it's really sad but that's why we do the show. We do the show, bring you on, talk about mortgage interest rates, kind of the different types of loans, because again, break up the monotony from my retirement plan and talk. But there are people that listen to the show that are looking to buy houses or refinance and stuff like that. So it's just good information for people to have out there, because I think with the massive amount of information that's available today online, it's almost too much. There's TikTok videos, there's social media, there's stuff online with Google, and everybody has an opinion because the internet allows that.
Yes.
And not all the opinions are correct. So I think it's important that, Luann, in our industry, we talk about a CPA, a financial advisor, preferably a CFP, and an estate attorney. Well, if you're buying a house or refinancing a house, you want to establish a relationship with a good mortgage loan officer or lender and make sure that you're getting good advice. I always recommend, I know, Alex, you're kind of more on the independent level, so you can search out different companies that are going to provide different rates, correct?
Yes, absolutely.
Yeah. And I think that's important. You go to one place that has 1 or 2 banks, I don't know. I think you're kind of limited, and that's why, we promote independent, in most all cases. So if you're listening to the show right now, you may be catching it on Sunday morning. You can hop out to Apple Podcast or Spotify and catch the whole episode. But we are now done with the first half of the show. Hope everybody's having an awesome and blessed week. And you can give us a call to set up your discovery session, not refinance your house. But if you want retirement planning, you can call 256-937-2010. Again, the number is 256-937-2010.
And Alex, thank you so much for joining us again. Alex Anderson, mortgage loan officer, Modern Lending Team in Nashville.
If you're pondering the longevity of your retirement savings with questions like, is my nest egg sufficient? Or how long will my retirement funds last? Consider scheduling a session with Chris Wallace. Text VISIT to 256-937-2010. Again, text VISIT to 256-937-2010 now to set up your appointment.
Quarters, just 25 cents. That's hardly anything, right? But Chris Wallace and his team at WG Financial see quarters a little differently. A quarter is a lot when it's a quarter of your retirement savings. Now, do you want to pay 25% or more in taxes during your retirement? Well, Chris can create a plan to help address that. Now, if the only time you think about taxes is when you file them, you don't have a tax strategy. But it's not too late to get one with the help from Chris Wallace. So act now to make sure you're not paying a quarter, dime, or even a penny more than you should. Call Chris Wallace and his team at WG Financial at 256-937-2010 to schedule your personalized tax strategy session. A quarter saved is a quarter earned. Call 256-937-2010 now. That's 256-937-2010. Investment advisory services made available through AE Wealth Management, LLC, a registered investment advisor. Firm may not give tax advice.
With so many worries in life, market volatility shouldn't be on your list. Help ensure your retirement plan is stable and independent of market swings. Just get in touch with Chris Wallace at 256-937-2010. That's 256-937-2010 to start planning.
Hi, we are so glad you joined us today. I'm Luann Fulmer here with Chris Wallace. And Chris, it's easy to make assumptions about what would go into a legacy plan if you just asked anybody. But you're going to actually help make a little more clearer for us as we dive into the basics of creating a lasting legacy for our family. So, Chris, what would be some basic questions we would need to ask about this topic?
Well, I think, just in general, and I run into all types of people, and we've talked about the different types before on the show. We have the family that, pays for the school and has done a lot to really launch the kids into adulthood, debt free, basically.
Right.
So the parents have paid a lot, right? So, and sometimes those parents are like, hey, we paid for the car, we did the school, and they're on their own, and we're going to spend their money. And they're, if they get some, great. If they don't, great. We kind of helped them get launched into life. And so I think really the first thing you have to do is kind of figure out what type of legacy you want to leave. And again, it's all over the map. I can tell you my own personal household. I'm much more of the want to leave a legacy, and Jen's like, let's spend the money, and enjoy retirement, which is that's fair. I'm like that to some degree, but at the end of the day, I want to make sure that, I want to leave, as much as I can to the kids, but I also don't want to cut us short either, because I've seen families where they are so zoned in on leaving a lot of money to the kids that, they don't focus on themselves. And I think, at least in my opinion, you've worked sometimes 30, sometimes 40 years to build this nest egg for you and your wife to enjoy retirement, or you and your spouse to enjoy retirement rather. Do that, make sure you're doing that, and then maybe make some memories along the way, with kids and grandkids as well. So understanding how and how much and what type of legacy, I think that's really important. And again, it's very emotional for people. I will say, as we get into the other questions here, most of the time, the mom, the wife in the relationship is the one that wants to leave and stuff for the kids. And the dad's like, I don't care. I pay for their school. I pay for the car, that sort of thing. So
yeah, exactly.
Yeah. So figure it out what you want to do. And then from there, I think you can work with someone, again, whether it's us or someone else, to make sure that you're creating that legacy that you want to create for the family.
Okay. Now, we always talk about your process that you take your retirees through, and that is the right retirement process, but we spell right differently at WG Financial Group. We spell it RITE, and it's an acronym. That's the reason. So retirement income, you focus on that. You look at their income. You look at their investment strategies, tax strategies. You help them save where they can. And then finally, the E in right is for estate and legacy planning. So tell us how you talk to your clients about this part of their plan.
Yeah. So we talked a few seconds ago about understanding, what type of legacy that you want to leave for the kids. So, and what I was describing earlier was we want to leave assets to the kids. But I think during this process, you also have to be prepared for the unexpected. So it's not just what you want to happen. It's being prepared for, well, what if what I want to happen doesn't happen and one of us passes away early? So you got to be, prepared for that. And sometimes that involves additional life insurance. So again, if you've got maybe some debt that you're still paying off, and if you're listening to the show right now and you're, say, under the age of 50 and you have a house payment and you don't have adequate term life insurance, I would say call us so we can get that knocked out for you. I mean, to me, there's no excuse for not having enough insurance. I've seen and actually heard from friends. As a matter of fact, our guest on the first segment, we were talking before the show about one of her good friends, her husband passed away. And they didn't have any life insurance.
No
so,
way.
And so again, if you're listening to the show, I normally say if it's us or somebody, call us, because we need to get on that and take care of that for you, just so that your loved ones are covered. And don't just rely on company insurance, because your company is not always going to provide as much as most people need. So you have to be aware of that. And then if you leave the company and the insurance is not portable, now you don't have any life insurance. So always get your life insurance outside. We are big advocates of term life. Even at age 50 or so, I think it's time to start looking at some life insurance kind of with long-term care benefits with it. Again, it's life insurance first, but you have some chronic illness rider benefits on there that can be used for long-term care. So being prepared for that unexpected is a big deal. And then, just the whole legacy aspect is, like you mentioned, Luann, it's the last part of the process. We
Yeah.
want to, it's kind of like almost like this legal wrapper in some respects,
yeah.
because some of it is legal documents, which
Mhm.
a lot of people out there listening to the show is like, the wife is elbowing the husband. I've been telling you, we need to update our legal documents now, or elbowing each other. Hey, we
Yeah.
need to go do that. Those legal documents are really important, because what that does is that preserves, in some cases, some of that wealth for your family. And it does make the transition of the assets easier in a lot of cases. So a lot of people think, well, it's in my will, but that's just a very basic way of listing the assets, in a will. And the will is going to tell the estate basically what to do once death occurs. But people forget that will has to be probated. So when that will goes into probate, now you can have people kind of challenge the will and things of that nature. Sometimes you want assets to go a little bit cleaner through the estate. And one of the cleanest ways to do that is put a named beneficiary on file. So, for example, if you have a bank account, now I said bank account, your checking, your savings, your money market. If you do not have a beneficiary, it's called POD with the banks, payable on death. You need to do that. Don't put your kids on the bank account, because if you put your kids on the bank account and your kids go out and get in a car accident and they're sued, it puts that account in liability, because their name is on the account as an owner. So you don't want to do that, but you do want to have them on there as a beneficiary. Most of the banks aren't going to ask you to put a beneficiary on a checking and savings account. That's important to have a name listed there, because if you pass away, one of the things that you were worried about when you put their name on the account as an owner, which is wrong again, was, well, when I die, they're going to need access to the money. Well, put it as POD, payable on death. So when you die, it goes right to them. They'll, fill out paperwork and probably have to show it. They'll have to show a death certificate, of course.
Right.
But it'll bypass probate.
Gotcha. So there's a difference. If they're a beneficiary and something happens to them, then it could actually dig into your account. But if it's a POD, then you're safe.
No. If they're, thought you had. I want to make sure it's super clear, because it gets really confusing.
So sorry.
This is part of my process.
Okay, sorry.
If you add them, so they're in my process. One of the questions that I ask: are your kids on the bank account as an owner? So in other words, you've got Mr. and Ms. Jones sitting there with me, and I'll say Mr. and Ms. Jones. Actually, I use first names. So I'm just going to say Mr. and Ms. Jones here. I love the personal side of it. So Mr. and Ms. Jones, you guys have a joint checking savings, right? Oh, yeah. Everything's joint. My name's on it. Her name's on it. I say, okay, cool. Any of your kids, are they on there as an owner? Now, most families will tell me no, because they don't put their kids on there as an extra owner. So in that case, it would be Mr. and Ms. Jones and son. So now you have 3 owners on that account. Okay. You don't want to do that, because son's name is on the account as a bank account owner. Son goes out, has a car accident. Son gets in a lawsuit because son's name is on the account as a owner. Okay, I see. It opens that account up for liability, potentially in a lawsuit. So these are all questions you want to talk to your estate attorney about. Putting them on there as POD, or beneficiary, another way to say it. Oh. They're not on there as an owner. They're on there if you die. Of course, we are all going to die at some point, right? So when you pass away, because the son or daughter or both are named beneficiaries, that account does not have to go through probate. Okay. Now, this is important. I'm going to keep going for a second, because this stuff is really, really important to tidy up your financial plan, and it falls under the E in the process. As I mentioned earlier, the husband might say, well, it doesn't matter, Chris. I got it all in my will. Mm-hmm. Okay. Let's take this bank account we're talking about. Mom and dad pass. There's no beneficiary. All right. You're with me so far? No beneficiaries, but it's in the will for the bank account to go to the son and daughter. They can't get to it until it clears probate. So it's in the will. It's got to go through probate. Sometimes that can take weeks, sometimes months. It just really depends. Right. Meanwhile, if they had just put them on there as POD, as beneficiaries, then it wouldn't have to go through that probate process, and it doesn't matter what's in the will. What a lot of people need to realize, and this is, if you're listening to the show today, this is why a lot of Huntsville will come, sit down and talk to us, because we go over stuff like this. We don't give you legal advice, but we go over basic stuff like this. You always want to have a named beneficiary wherever you can, because a named beneficiary is going to trump the will.
Okay.
So,
Wow. Yeah,
Yeah.
that's good. Yeah. Sorry for my confusion there. And I hope I didn't confuse anybody. I think you explained it really well. So
I'm actually
good there.
glad you did ask me that because it made me go a little deeper.
Mhm.
And I'm glad that it was a little bit confusing there because
Mhm.
if it made you misspeak a little bit, I'm sure that the listeners out there a couple of them may have also not heard me correctly as well.
Right. So,
And maybe I
okay.
didn't explain it as well.
Yeah. No,
But hey, we
that's
did.
good, though.
We
There you
did just now.
Yeah, you did. You did.
Exactly.
So we're good there. Oh,
Mhm.
wow. Okay. So that was my question about, that part of your plan is estate and legacy planning.
Mhm. Let's talk about strategies.
Yeah. Okay.
Let's talk about strategies.
Yeah, that's good.
I'll just give myself my own question. How about that?
Okay. So I'm like, I didn't want to, I'm looking at my list here. I didn't want to repeat a question. So go ahead.
Yeah. So let's talk strategies for a minute. All right. So when most families want assets to transfer to their beneficiary in really the most tax efficient way,
Mhm.
they want them to go to the beneficiaries. That's all. We understand that. But most of them want them to go or transfer to the beneficiaries in the most tax efficient way. So one of the ways that you can do that is just by ensuring, how you're dealing with the money today. So let me go over some basics here. If you, thanks to the Secure Act 2.0, or actually thanks to the Secure Act 1.0, they changed. Maybe I should say no thanks to the Secure Act 1.0. So I'll say no thanks to the Secure Act 1.0. Okay. So what they did was they changed the inherited IRA rules. And I think everybody out there listening to the show right now is very familiar with it. So you die with an IRA and a non-spouse beneficiary gets it, like, let's just say son or daughter in this case, since we're talking son and daughter in the other example. So they get this IRA and son and daughter are going to split it and they're going to open up what they call an inherited IRA. And they're literally going to have 10 years to pay all of the tax on that money. So let's say mom or dad, they die with a $2 million in IRA. Son and daughter get it. It's $1 million apiece. They got to split it. They got 10 years to take the money out. That can be a very expensive RMD. If you just take $1 million divided by 10, it's $100,000 a year. The likelihood of son and daughter being towards their peak earning years is pretty likely. So that RMD may cause them to go up a tax bracket. And so it's important to think about that you're going to pass on IRA money to your kids and they're going to have to take RMDs and they're going to have all the taxes paid by the end of the 10th year. If mom and dad were already taking an RMD, the kids have to continue that RMD.
Right.
Okay.
Yeah.
And again, they have to have it all paid for by the end of the 10th year. So that's important to know because, again, it may bump them up in a tax bracket. So that's the kind of the no thank you Secure Act 2.0 rule or Secure Act rule that was changed in the original Secure Act. Now, there is something you can do with a pre-taxed IRA. There is a way to use something called a charitable remainder trust. And what this essentially means is when you pass away, the money will go into what's called a CRT. And the basic high-level rules, these things are really complex, and not every attorney does these. This is not for your strip mall attorney. This is for your high-end estate attorney that knows how to do these because they're a little bit complex. The high-end rules here are that 10% of the assets have to go to charity when the trust is done. But what you can do is you can kind of circumvent that 10-year rule for the IRA where you have to pull it out over 10 years. And with a CRT, you can stretch it out as much as 20 years. So in some cases, the beneficiary might actually get more money over 20 years than they would have gotten in 10 during that 10-year period. And it gives them a little bit more time to pay the tax. And then 10% of that goes to the charity. So some people say, well, I'm not charitable. I say, okay, well, do you want the IRS to have it or would you rather give it to a charity? Oh, I'd rather give it to a charity. Congratulations, you're charitable. So that was supposed to be a joke, Luann. Laugh a little bit. Come on, stay with me. I know this is complex. I may be losing you a little bit. So anyway, so you can play with if you have a really large IRA, in some cases, again, if you're charitable and you have kids that you want to help them stretch it out over 20 years, a CRT might be a good play there in some cases. Let's talk about Roth IRA money. Okay. So we're talking about optimizing tax legacy. All right. So say, for example, you die with all Roth IRA money. So you might be thinking that the kids can stretch that Roth IRA out forever. They can't. They will only be able to leave the Roth money inside the inherited Roth IRA for 10 years. Okay. In my opinion, this is not an opportunity for a CRT. And I'll tell you why. We always kind of rule of thumb, if you're listening to the show, rule of thumb. This is a rule of thumb that is a very good rule of thumb. I think some rules of thumb are not great. This one is. You always want to give to charities your least tax efficient money. So we want to give charity some IRA money because they don't pay the tax. And if you give it to them, they don't pay the tax, and then your kids don't pay the tax. I have seen situations where people have had beneficiaries backwards and they didn't even know it because their old brokerage firm just listened to what you told them. Hey, put the beneficiary as the charity here on this non-qualified assets. And when I die, X percentage is going to go to charity and the full IRA goes to my kids. Well, that's completely backwards because on a non-qualified account, securities are inherited at a stepped up basis. So you want the kids to get that money because they're going to inherit it at a stepped up basis. And when they do that, they don't really owe any tax. They could sell the securities at that point without owing any tax. The charitable portion of your estate should come out of the IRA. So always want to give our least tax favorable money to the charity. So going back to the Roth again, you can only leave Roth IRA money in a Roth inherited IRA for 10 years. And then it has to come out of Roth status. And then it'll be, they won't pay any taxes on it. So they can leave it in there for 10 years, won't ever owe a dime in taxes. At the end of the 10th, they can move it out of the inherited IRA. The account has to be empty. And then it can go into like just an after-tax non-qualified account. So always wanting to be planning for this. So you need to understand the rules because there are rules here. And you want to understand what are my options so that I understand how to preserve as much wealth as I can for future generations. And then if I'm charitable, what are the real efficient ways for me to give to charity? So again, make sure this charity thing's really clear to people.
Right.
Let's just assume that you have, just say you have $1 million. You have $500,000 in non-qualified, non-IRA money. So just regular securities in a brokerage account, $500,000. And let's say you got $500,000 in an IRA. If you're going to give 50% to charity, let's say you're really charitable and you're like, okay, I want to give 50% of my assets away when I die to charity. You want to do the IRA because if you give the IRA to the kids, then they're going to have to pay the taxes on that at some point. So we want to give that $500,000 to charity. We want to give the other $500,000 of non-qualified to the kids because they inherit it at a stepped-up basis. Yeah. Okay, so understanding the rules again. I've seen this stuff backwards, and my staff knows how to sniff this stuff out. Like when we see stuff like that, we're like, hey, that's backwards. We need just a simple change. This is how we can help you. We can help you get that fixed. So,
love it. Now, real quick, I want to mention your lunch and learns, Chris, because this is something that you guys do for companies. If someone is the HR person of a company or the owner or the president, Chris would welcome the opportunity to hold a lunch and learn for your employees. And he does this complimentary, for businesses here in the Huntsville area. And he would love to help your employees better understand some of these very things that we talk about here on our show. He would love to, make sure that everybody's on the path to success for retirement. So all you have to do is call 256-937-2010, 256-937-2010 to schedule that complimentary lunch and learn for your employees. And again, thanks for joining us. You're listening to the Rocket City Retirement Show with Chris Wallace of WG Financial Group. I'm Lou Ann Fulmer. And today we're talking about the importance of creating a legacy plan for your retirement and for your dear family. Is there anything else you need to say about basic documents we need to consider for an estate plan, or should we move on?
Well, I'll just kind of reiterate, because I see this a lot. I mean, it's probably, and I'm kind of swagging a number here, but I'd probably say more than 50%. I'd probably say as high as 70% of people that come in to see us. And again, we're not estate attorneys. We don't do these legal documents, but I ask the question, do you have them? And the majority of families that I talk to or individuals don't have updated documents. So usually I think you need to be reviewing your documents with your attorney probably every 3 to 5 years. Not necessarily because things haven't changed, because that's what I hear a lot. Well, you know what? Right. Nothing's changed. Well, the laws might have, and you probably missed it because we're not, in tune with that on a day-to-day basis. So I just say every 3 to 5 years, just give your attorney a call, sit down, make sure that the documents that you have are still, in play and good. The reason for that is you may have a power of attorney where laws may have changed from, say, 15 years ago, and the banks and institutions that you're going to put those on file may not take them because they may not have certain pieces of language. So again, that's all stuff for your attorney to, go over with you and kind of go into those weeds. But you really need 3 basic documents. So you need a will. Everybody needs to have a will. And remember what I said earlier, if you have any spot in your investment assets or accounts, financial accounts, you always want to put the named beneficiary there. The other document that you'll need is basically powers of attorney, durable power of attorney for healthcare and financial, and then also advanced directives, which is really your end of life decisions there. Right. And that was the hardest one for me. So really? as I'm sitting there filling out the estate planning packet for my attorney, I'm like, well, what if there's like this unknown strategy thing available?
A cure.
That's available.
Cure.
20 years from now, that's not available today. Yeah. Like, how can I mark that on here? Because like once you mark it, I mean, that's what they kind of have to abide by. I think in Alabama, I believe, it's a question for your attorney. I think a couple of doctors have to consult with each other before the final decision is made.
Yeah. Or, what are you saying? Keep me on ice just in case?
Well, keep me on ice, like Han Solo from Star Wars. You remember that?
I'm thinking of Austin Powers. I don't know.
Or Austin Powers. Yeah. Another good one. Good one. So, so you'll want to find that out. Because anyway, that was the hardest part for me, was filling that out. My wife was like, nope, no feeding tube. Nope, nothing.
Yeah.
Like, let me die, and I'm like, but what if there's a chance, So that's how I was filling it out.
You're so funny.
It was. We were sitting there together and I was just laughing because I said, I know what your market is like. Nope. Let me die. That sort of thing. But that's how
market for me.
And that's how a lot of people, listening to the show, they're probably like my wife, just let me die. Don't drag this thing on. And I'm like, but what if there's a chance? So we'll. It's also advanced directive is also called living will. So you might know that as a living will. The other thing that you may want to talk to your attorney about is a trust. Okay, and again, I'm trying to make sure that I toe the line a little bit, but not give legal advice here. But this is when I think trust makes sense. Sometimes you may have a child where maybe they're not as responsible. We'll just say it that way. Maybe they're not responsible. And you really don't want all the money to fall in their lap at one time. So maybe sometimes it's best for that money to go into a trust and wait until certain ages to start distributing that money out of the trust. You can do it however you want to do it. There's different ways to do it, but I call it like putting a faucet on the trust. So like if you don't, if the son or daughter is not as responsible, maybe they don't get anything until they're 30. So with our particular family, we make them wait until they're 30, and then they can have all of it at 30, because we kind of feel like, okay, at 30, your dad's a financial advisor. He has a radio show, TV shows, plenty of material for you to listen to. If you don't want to listen to him at home, you can watch it online. Go to YouTube or something like that, or put a podcast on of your dad. So we felt like at 30, they can have everything. So that might be the use of a trust. The other area that I find is very useful, and again, get this information from your attorney, if you have property in multiple states. So there's some people that have condos down in Florida or over in Tennessee, or maybe out in Colorado. You want to have a trust and have those properties inside the trust so that you're not probating in multiple states. So that would be another potential, need for a trust. I think sometimes the word trust is thrown around as a protection type of a vehicle. And it is in a lot of cases. So a trust is different from the will, because the will has to be probated and it's public information. So you can, the public can get information on that. A trust is private, and a trust in a lot of cases can't be penetrated by creditors and predators. So, that could also be some use for a trust as well. But again, these are all, I think, great questions for the attorney that you're working with. I'm just trying to throw examples out there just to help you think through this process. I've heard before, I've had some people come into me, they have a, maybe a medium-sized estate, maybe like 500,000, no other property, no other states. And they're like, I'm thinking about a trust. I'm thinking about a trust. Probate here in Alabama is not that bad. It's not that expensive. It's not that bad. Now you get down in Florida, it's a little more expensive down in Florida. But I think some people, again, just kind of going back to that protection thing, where I was headed with this was some people think it protects you from Medicaid, and that's not the case. What I'm referring to here is called a revocable. I have a hard time saying it like most attorneys. I call it revocable.
Oh, right.
Yeah, it just means that, it's in your Social Security name, or not, it's under your Social Security number, and you can revise it if you see fit while you're living. It's revocable, right? Okay. It's when you die, it becomes irrevocable. This is not a Medicaid trust. That's a whole nother ball game and a whole nother, can of worms I'm not going to open up on this particular show.
All right. You get one or two more questions, probably one. So you can either talk about some missteps that you've seen to, maybe to show people what not to do, or do you want to just go ahead and start with, or explain how we can start creating an entire plan like we always do? You get to pick.
Yeah. So missteps.
Okay.
Not having named beneficiaries on file.
Yep.
So if you have, most of the time, unless the IRA is really old, you're probably going to have a beneficiary on file. Where I see it mostly is in the non-IRA accounts where there's no beneficiary named. And at that point, it's going to go to the estate. If you don't have a named beneficiary on your IRA, then it is also going to go to your estate. And I believe the rule is still you have to have that account completely liquidated within 5 years. So it's even shorter time than the Secure Act law that's 10. So named beneficiaries is huge. Not having, I'll go to another area. This is more on the legal document side. Not having that power of attorney named or in place. Because there are times when you may need that. The older you get, then you may need that. I have it on my kids. So my kids are in college. They're seniors.
Right.
My daughter is age of majority. She's also in cosmetology school. I have POA for them.
Right.
I'm their agent. So is Jen. We're like split agents or co-agents, I think is what it's called. And I have that for them because they're age of majority. And I can't make a decision for them as a parent without that power of attorney.
Right. Okay.
So if, kids are at college, my sons are great. They better be great. They're working and going to be working in the business.
Yeah.
But, kids at college do college things, right? Things could happen. And so what we did was we put a POA in place where we have the ability to make decisions for them should something, really bad happen. Now, what are the chances of that? Probably not super likely, but in the event that it does, I can sleep better at night knowing that I have my own personal legal documents taking place. And then I also have what I need in place for my kids until they get married and their spouse can be their POA and stuff like that. So those are just types of mistakes, Luann. And I went a little bit deeper today because I feel like these shows need to be interesting, right? I mean, it doesn't, sometimes even as the show host, to be honest, I'm like, we talked about Social Security and we've talked about Social Security a lot. I want there to be meat. I want people that listen to the show to be able to take and do things and get part of their lives, squared away so that when they come in to see us, there's part of that's already taken care of. And they're just going to come see us for the retirement planning. I'm still going to ask these questions. We're going to go through it again. I'm going to make sure you have those documents in place. If you don't, you're getting a referral from me if you don't have an attorney, and you're going to go see that person and hopefully get those taken care of. But again, I wanted the show to be, I want it to be meaningful. And that's why we had, Alex on in the first half. And, it's not normally what we talk about mortgage rates, but there's some interesting stuff there. I know that when, as I've known her and gotten to know her, there's parts that I've learned that I didn't know about. And you could probably tell in the first segment, there were a couple things I really didn't know. I was able to ask a couple more questions. So got another guest next week.
Okay.
Another guest. Yeah. So we're going to, it's in the mortgage area too. I'm not going to give too much of a, well, I will give it away. It's going to be about reverse mortgages. It's not something that we normally recommend, but it's they kind of have the same stigma like annuities, like, reverse mortgage. But they've changed a little bit. And for some people, not everybody, of course, they make sense. So I'm going to have a guy by the name of Matt on the show next week. And we're going to talk a little bit about reverse mortgages. So we just get the information out there. That way people know how these work. And, if you know how something works, you don't have to be as afraid of it, right?
Exactly,
So I remember the first time I bought a handgun, I was kind of afraid of it when I first bought it.
Yeah.
But you take the lessons, you learn how to use it. It's not necessarily something you need to be afraid of. So anyway, I hope everybody enjoyed the show. If you want to give us a call to set up your discovery session, you can do that by calling 256-937-2010. Again, the number is 256-937-2010. Hope everybody has an awesome and blessed week. And remember to serve every person in every situation with a servant heart.
A Roth conversion is a taxable event and may have several tax-related consequences. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA.
Investment advisory products and services made available through AE Wealth Management, LLC, a registered investment advisor. Insurance products are offered through the insurance business WG Insurance Services. WG Financial Group is an investment advisory practice that offers products and services through AE Wealth Management, LLC, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by WG Insurance Services Services are not subject to investment advisor requirements. AWM and WG Insurance Services are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. WG Financial Group is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by WG Financial Group. This radio show is a paid placement.